You guys, we love doing these types of conversations. For me, I feel like it's an inside look. It's kind of like a peek behind the curtain, if you will, of the types of discussions that we have internally as your advisory team each week, and a lot about what goes into these conversations. Ultimately, it helps us and it influences decisions made when it comes to your investments. And so our goal today is very simple. It is, of course, never to predict the market. I wish we could, but we can't. But it's to help you kind of understand what's actually happening and how it's impacting your plan. Because the reality is always, like, headlines are loud. They especially are right now. It seems like they always are. But your financial plan, your investment strategy, it should never be reactive to that noise. So we're going to walk through the 5 key themes that we're watching and what they mean, and what, if any, adjustments we're making as a result of those. So Matt, let's start with, I feel like the Fed is a good place to start, and then we can kind of flow everything from there. How's that sound?
Yeah, that sounds fantastic, John. Let's start with the Fed. And we're going to show interest rates here. We're going to talk about the Fed funds rate, and we're going to try to not make this boring, right? What I don't want is our attendees' eyes to begin to glaze over as we get into Fed economic policy. I want to make this not simplistic from a simplistic sake, but from a way that you can understand this information. And the graph you're looking at right now is our Fed funds rate. Remember, our Fed is really has a mandate of 2 goals. The first goal is for maximum employment, right? Their goal is to keep our population as employed as they want to be. And the second mandate that they have is price stability. And price stability really encompasses the conversation regarding inflation. And we're going to touch on both those in great detail here today, because those are both things that impact our clients, impact our decision making in our portfolio. Now, what you'll see on our page here is a charting of the Fed funds rate. And the Fed funds rate is one of the many tools that the Fed uses to control our economy. If we are running too hot, they take appropriate action and move interest rates. If we're running too cool, they move in the opposite direction. And there's very few things in our profession that we get to show a forward-looking model of, but the Fed funds rate is one of those very few things that you can see. And if you look at my screen here, you'll see that the graph moving up and down actually has 3 different colors. The dark blue color is where the Fed believes interest rates will be at the end of the year. The green is where the market believes the interest rates will be moving forward. And then there's the long range projection also produced by the Fed. And I think what you'll see here is just this overwhelming theme that interest rates are predicted to continue to decline. Now, how much and how fast and how volatile, that has slowly worked its way back over the course of this last year. In fact, I remember showing this graph in one of our previous quarterly economic updates, and it was a very volatile downturn. We predicted, and the Fed predicted, and the markets predicted multiple reductions in rates in order to achieve those 2 mandates. And what we've seen is that slowly has backed down from a multiple rate cut scenario to potentially maybe one this year. And for us, that's really, really important, because it will impact, again, the inflation conversation we have in a moment, the jobs, and then most importantly, how our portfolios, specifically in the fixed income space, react to the reduction in interest rates. So this is the fundamental component of any economic update: is how is the economic policy in our United States being impacted, and what is our Fed doing to control, as best to their ability, how our economy is either running too hot or too cold.
So it sounds like they're playing a patience game right now. I mean, they're not racing to cut rates further at the time being. And I think for all of us, listening, I think, what that really means is maybe a few different things. Thoughts come up about borrowing. You think about borrowing for automobile purchases and things of that nature. Borrowing is still expensive, so we want to be thoughtful about that. And I think, at the same time, this is really one of those first periods that this past year or two where things like cash and bonds are actually paying you something meaningful, and we don't feel pressure to go stretch for yield that portfolios on the bond side were so starved for if you go back, the last 15 or so years. So overall, I think it just reinforces the idea that we don't need to make big reactive moves. So stay
Yeah.
disciplined, diversified, and we can't outguess the Fed. right? So it's
And
like,
I think it also, yeah, it points, John, to the resilience of our economy, right? We've been through last year's theme of tariffs, this year's theme of, this conflict that we have in Iran. The economy has been quite resilient to a lot of these external factors. And so I think that gives us a little bit of a peace of mind of the resilience of our economy. And the Fed supports that with not having these major drastic cuts and reductions in rates, which would be to spur growth. And
yes.
the Fed, again, according to these charts and the economic data we look at, says, hey, listen, it could still, we still could use a little bit of maybe a push in the economy, but we're going to slowly begin reducing rates here,
Mhm.
and maybe not do it as fast as we once thought would occur. And again, it kind of goes back to the resilience of the economy.
Well, and also I think, inflation is really one of the key reasons the Fed is being patient too. So maybe walk us through what we're seeing there when it comes to inflation.
I love a colorful graph. By the way, we only had 3 colors on the last one. I think we have 5 colors on this one. I mean, nothing is better than a colorful graph, right? But this one is really,
Six,
really
but who's
important.
counting? Six.
Six. Okay, got it. This talks about our inflation, and inflation is really measured in 2 separate categories. We have headline inflation and
Yeah.
core inflation. Headline inflation is what us as consumers deem is inflation, because headline includes the 2 most volatile categories of inflation, which is energy and food prices. What do us as consumers do the most? We eat and fill up our cars with gas, or buy products that need to be shipped, whether it is using a truck, a semi truck, or a semi trailer, or coming by some other means. Those are our 2 most volatile categories. So us as consumers, we look at headline inflation. The Fed, though, doesn't. The Fed looks at core inflation. The reason why they do it is that they exclude those 2 very specific categories, because those 2 categories are immensely volatile.
Mhm.
Let's just take a look at energy, right? Energy right now, if anyone's obviously filled their car up in the last week or month, is here, especially in Florida, is paying a little north of $4 a gallon. 1 year ago, that was $3 a gallon. 5 years ago, that was $2.60. An immense amount of inflation comes with energy, and that's oftentimes because there is either a conflict going on, or there's some other external element there. It's not necessarily a supply and demand. So the Fed is looking at core CPI, core inflation, and again, us as consumers are feeling that headline, which is all of these areas. Now, not everything is overheating, right? And I think that's the point of this graph, is there are still certain areas that are still high, as I mentioned, energy, food prices. There are other pieces that have really leveled off. That might be housing. That might be the core goods portion of our CPI. So I think this sets up a case for going back to the conversation we had a second ago with why is the Fed maybe backing down, is because, except for a few very specific categories, inflation is under. And I know I'm flying in the face of everyone again saying, well, wait a minute, Matt, I just went to the grocery store and I just filled up my car. It's never been more expensive. Yes, I agree with you. But the Fed looks at it in a different light in order to be able to make economic policy without huge fluctuations. If they're basing it upon energy and they're changing their economic forecast based upon something that might be happening just quote unquote temporarily, then that could pose a disaster for the remaining categories.
It's interesting. I mean, I think this is a good chart because it is very interesting. And the comment that you made lends to the first Q&A that we got, which is, a great question that comes up a lot right now is like, if inflation's coming down, which like we're talking, I mean, economists are talking about the expectation going into 2027 that it's reasonable that inflation could be at or below 2% in a year from now. So the question is, if inflation is coming down, why does everything still feel so expensive? And as I mentioned, it's such a good question and a common one that we're getting, because like even though the data here that we're illustrating is showing that inflation is lower, the reality is prices didn't go back down. Like, they just stopped rising as fast. And so your baseline cost of living is still higher than it was a few years ago. And as you can see, it's such a stark difference from 2022 to now. But I would, one of the things that I would add is that like this is why, when we're building a financial plan, this is why we continue to build inflation into your plan, because we know this is a very real life situation. So, kind of as you were saying, Matt, it's like at the grocery store, at the gas prices, it doesn't feel like things have come down at all. And yet we look at this chart and it's pretty interesting, isn't it?
Yeah, probably two additional pieces that also are impacting this. We had this. So funny that this exact quarterly economic update, we had this 1 year ago for the first quarter
Yeah.
of 2025, and we were talking tariffs. And I even remember we laid out 4 different scenarios for the tariffs, and we shot this video. We did this webinar right around noon, and as we were quite literally going through the 4 different scenarios of the tariffs, it was changing in real time on TV. In fact, we always have CNBC up, or whatever economic update we have. We're watching it, and I can see out of the corner of my eye that, hey, by the way, tariffs are rolled back. So everything we had just said in that moment really was for naught. And so that still, though, is playing a part of our economy, even though they have been ruled unconstitutional and they're now going through litigation. Still pushed up prices. And then the last piece here, which is an interesting one, and I'm seeing this firsthand. I think everyone on this list here, we're assisting them some way in tax planning. For the most part, the refunds this year are higher than last year. And I really looked at 2 different areas. Both of them are legislative. The first is for our seniors over the age of 65, making under a certain adjusted gross income. What did you guys get this year as part of your deductions, right? There was an additional deduction, that senior deduction. It was $6,000 for a single, $12,000 for a married couple, again, under a certain threshold. And then the second piece to that, from a tax trend standpoint, is the SALT limitation. As John mentioned, we have our clients in here from New York and Connecticut and California. You were limited to the first $10,000 of taxes as a deduction on your return. That has gone up to $40,000. Right, wrong, or indifferent on either one of these economic policies, they are still causing more money to be included in our economy. And again, that additional cash also pushes up inflation in a sense, because there's more money to spend and more cost and more goods and services that we can consume. So 2 additional pieces that kind of came up as we thought through this. A lot of moving pieces when it comes to inflation.
Yeah, it's so interesting that those, something as simple as like tax refunds, or, the amount that people are getting back being bigger, potentially increases inflation in the short run. But again, I think that's one of the reasons we're talking about this, is that, it doesn't change what we're doing from a planning point of view. Like we've got to build inflation into your financial plan. And then I think the other thing that this really echoes for us is staying focused on the long-term investing, because that is historically what has been able to outpace inflation. And so, speaking of investments and investing, I think this is probably a good natural segue. But if you've looked at your statements for quarter end, things probably look pretty solid. Like even despite the market volatility of the last month or two, things look pretty solid. But there's a pretty interesting story in the markets themselves, at least in the U.S. markets, that's kind of taking shape. And so, I think that's one of the next things that we really want to dive into, is when you look at, a lot of the market gains that we've seen over the last few years, it's really come from a small group of companies. Names like NVIDIA, Microsoft, Apple, all names you've heard of. And to be clear, like very great businesses, like there's no question about that. But if you look at this here on the left, I think this is where it really gets interesting. You can see here earnings growth by sector. Technology is growing at a pace of 45%, and everything, it's outpacing everything. It's more than doubling everything else. And over here on the right-hand side, when you look at top performing companies this year, a huge percentage of them, again, coming from the tech sector. So some of those concentrated companies that I just mentioned.
Yeah, it's so funny, John. We call it the S&P 500 index because we assume that we are, and that's what we're looking at here is one of our many indices that we actually look at. But we really shouldn't call it the S&P 500 index, because really what this is 7 to 10 stocks over the last 5 years have made up 67% of the return on average. So let me say that in another way. 7 to 10 stocks are driving the returns of the S&P 500 index alone. And that's always an uphill battle that we face as financial advisors, is really taking what you see on the news when you get home at night and they talk about the Dow Jones or they talk about the S&P. that doesn't represent really what our clients own as part of their portfolio. If this was the only thing we did the last 3 years, you're happy. But I distinctly remember very early on in my career that tech was also a very bright spot. And this was like, call it the early 2000s. I don't want to date myself, but we thought
I think everybody
pet.com was
here
going to
remembers what happened then. Yeah.
we thought pet.com was going to be worth, $1 billion, and everyone was, shoveling money into it. I'm not drawing parallels to the earlier tech crisis. The parallel that I'm drawing is that we still preach broad diversification. And that when you look at your portfolio, if the only thing that we're investing in is the S&P 500, that is a very, very concentrated position right now because it's market cap weighted. When we look at our portfolios that we talk about in our meetings, we will mention the S&P because it is a very large indices, and it does serve a purpose of a litmus test of where we're at in relative to the markets.
Well, it's relevant too. We all know of it. It's relevant.
We all know, we see it, and we talk about how did your portfolio do against the S&P? Another way to say that is, how did your portfolio do against about 10 stocks? Most of our portfolios have thousands of stocks inside of it, and not just in the tech sector, but across broad swaths of the market, looking at places like high yield and high income and dividends and all of those pieces that we have. Small cap. We're going to touch on international here in a little while. So just to be very, very clear that this is the fun part to talk about, especially over the last 3 years, but it certainly is something when we have someone come to us, especially a new client, and they say, here's what I have, and they're very happy and proud of it. And we have to come back and say, like, now we can look underneath the hood. And this is really what you pay us to do, right? Yeah. It is to separate out the myth from the reality of what happens inside of a portfolio and how a portfolio is constructed. And that's something we just absolutely love to do. It's just one of the pieces here that I just absolutely love, and I know John does as well, is making sure our clients' portfolios are structured correctly and not just following the latest and greatest trend. This has been a good place to have money invested, and all of our clients have a piece of it there. But I said a piece and not all, and that's a really important distinction.
Yeah, when we were talking about this earlier this week and just kind of preparing for this conversation, you brought something up that I think is important to note. So I'm going to steal your thunder because this was your idea, but I'm giving you the credit. But you talked about what we call the IPS, which is the investment policy statement. And I think that's where the discipline really matters, staying committed to this guiding document that influences and states like, hey, this is how we should be investing for each and every single one of our clients. And everyone's investment policy statement is different because it's specific and unique to them. Because the natural tendency would be to look at this and go, oh, well, like, let's own more of what's working. But historically, as we know, that's not what ever really works out. Everybody wants to buy low and sell high, but what ends up happening is, we end up trying to chase return or chase performance and not having a disciplined approach that is informed through an investment policy statement that determines how we should be investing is how one can kind of get into trouble. So for us, it's, the concept of just continuing to build portfolios that are designed to be durable and not dependent on a handful of companies to carry the entire market, because that won't always be the case.
Yeah, the other point there is to rebalance, right? That's the point of that IPS. Each and every client has the investment policy statement. And what that does, it takes the emotion out of our investing, right? And that's the key to investing, is to invest not with your heart, but with your head. And the IPS for us allows for that irrational exuberance, which exists, right? You look at this, you look at some of these names, you look at some of these returns, and you think, wow, I'm so glad I have exposure. Let's do more, like John said. You'll notice, and we say this in our meetings, hey, this did great. Here's what we're going to do. We need to rebalance out of that. Not because this isn't strong, not because it's not great, but if we're going to follow in line with our investment policy, we can only keep a certain amount as exposed to different areas. And again, what that allows us to do is take all of the emotion away and really look at it from a black and white ones and zeros standpoint. Allows us to make these very oftentimes difficult decisions without us questioning, is today the right day? Is this the right time? Is this the right move? Our financial plan, which dictates our IPS, are the two pieces we need to make sure that your portfolio is never concentrated in one area, or if it is, know that there's a reason why, and we can explain that and be able to come up with the plan, but would probably have dictated that.
Yeah. Since we're talking about equities, I think it's a good kind of segue naturally to just talk about the markets as a whole, because when we talk about valuations and we say, oh well, valuations are still relatively high compared to long-term historic norms, one of the things that we use a lot, and if you've been on these meetings with us before, like we talk about what's known as the price to earnings ratio quite often, and it's just a way to describe, is the market in general at the moment, is it expensive? Is it on sale, which is this line, or is it fairly valued at the moment? And right now it's trading at 19.7 times earnings.
The math here is quite simple. I mean, there's nothing complex about this chart. And I think those that are on this call, that I've showed this in just about every meeting. And it's not to point out a specific number as much as it's showing where are we at in the market cycle, right? This is all about market cycles. The price to earnings ratio is taking the earnings of a company and dividing it by their price per share. Mathematically, it's two numbers, and that comes up with a ratio. And that ratio is what allows us to have the discussion of, is now an expensive time to be investing, is now a fairly value time to be investing, or is now a time where there is tremendous amount of opportunities inside that market. And you look at this graph, look at some of the numbers here. 1994 is when this chart started. Look at that. Look at all the way up to 2000, right? Markets are in an incredibly overvalued state. And that's nothing more. And again, it's easy to look at this backwards, by the way. That's that dot-com bubble we talked about. Look at all the way down in 2008, 2009. We were all there for that one, right? Markets were incredibly undervalued due to prices being so low. And then we have the COVID, right? What a fascinating one, not going through it, but looking at it and studying it historically, is look at these major spikes, right? In 90 days, markets lose 30, 40%. Over the course of the next 6 months, rise 30 or 40% from the base, right? Huge, big movements. And the way that I like to look at this specifically is, when is the time to rebalance? Or for our clients who are still in accumulation years, and there's some names on here, we got some young ones, when they have that cash sitting on the sidelines, when is the most appropriate time to be entering into the market? We're probably doing some level of dollar cost averaging in their 401ks. That has a purpose, but it's really, hey, I got that bonus. I got that, I got this cash sitting here that's accruing. Where's the right time? We want to stay away from the markets during those very high periods where price and earnings are not in aligned, and want to wait till we get to more of a fair market value. So again, very long explanation for a very simplistic chart, but incredibly important and a big part of our planning process.
Yeah, I think that's a good point. And it doesn't mean we're necessarily bearish on it just because they're at this point. All it really means is that the stock performance has outpaced the earnings growth. I mean, that's really fundamentally all it means. But if you zoom out a little bit, Matt, and just because obviously US stocks have done well in recent years, and they're a little bit more expensive historically, if this is, if we go based off this chart. And so it kind of naturally leads to the next question, which is like, what about the rest of the world?
Yeah. Such a great point.
Yeah.
And, nothing better states what I'm about to talk about in a moment, that past performance is not indicative of future results. It is the cliche of our industry. And while it is very much a cliche, it also very much is fact. Oftentimes, and you'll see part of today's presentations, we're looking backwards to see where things are going forward. But we're doing that mostly from an economic standpoint. We're looking mostly at the way the economy has worked and how has it reacted under certain circumstances, and then applying that to our future. When it comes to looking at specific segments of the market, that doesn't work. And international happens to be one of those areas. For the last 15 years or so, the international markets, really everything ex-US and ex-emerging markets, those developed nations have underperformed US markets. And so really hard, again, when we're having these client meetings and we do talk about performance, and the US market did this, but we have some international exposure and it did this, the question comes up, why? And the answer to that question is years like last year. Last year, the international space was fantastic. The developed countries relative to the US market did really, really well. And I'm
Mhm.
really happy we maintained our discipline and had exposure there. And so the international space for us has been an area where we want to maintain some exposure. It does help diversify away from US, and again allows us to have that global exposure to the markets and in your portfolio.
Yeah, a couple questions came up as you were talking about that. I think you sort of answered one of them in real time, but it was, why would I like why should I own international if the US has been doing better for so long? And I think, a little bit of what you stated, and yes, that has been true in prior years, but that's why valuations are higher today in the US. And we don't invest based on what's already happened. I think you opened this slide with saying
Yeah.
past performance is not indicative of future, and we want to make sure we're positioning ourselves where opportunities are. And so, international is less crowded, maybe more reasonably priced. Also, if the dollar weakens, that becomes a tailwind for international.
It's
So
a
there's a
great
lot of
point.
different variables that are at play. And so just kind of summarizing some of those pieces that you said. Second question that I really appreciate and I think is a good one to answer is, when it comes to international, like, or what are we talking about here? Like, are we talking about countries like China? And I know we're going with that question, but I'm curious how you would answer that.
Yeah, we mostly stick to developed countries as our current portfolio stands. I think there is a time and a place for the emerging market space. Emerging markets are very volatile. They are very much dependent on commodities, and because of that, their economies are very volatile. Our
Hmm.
clients are looking for stability. Our clients are looking for sustainable growth, and so for that, we for the most part stick to our developed countries. And those
Mm.
developed countries we talk about are the UK, Japan, Germany, Canada, France. The closest thing we get to China is Taiwan due to the semiconductor exposure, right? All of these computers and all of this AI boom, they're all getting their chips from Taiwan. So there's some exposure that we have for our clients there. And so, again, the international space is not making up 50% of our portfolios, right? It's a piece amongst a very large puzzle. But for our clients, having exposure to those areas has been a real big tailwind. And you mentioned a really big point there a second ago, John, was the piece for international that is very impactful is how the dollar is either weak or strong. And that
Mhm.
weakening dollar allows more purchasing, more exports by the US, more purchasing and imports by outside countries, and allows it's another component to the investment piece is that US dollar. And that weakening dollar has certainly been a tailwind for our international space.
Yeah, well said. Yeah, I agree with all that, and I think I'm gonna shift gears. I'm gonna take a hard right pivot here because I think this wouldn't be a good quarterly update if we didn't talk about labor markets for a moment. And I think that it's important to talk about. It's a little more nuanced, but one of the things that we're mindful of is job growth is clearly slowed. Like if you look at the data, payroll growth is barely moving, and in some cases, like employment's actually declined. And I think we're expecting that to continue. But then at the same time, it's so interesting, like unemployment rate, it's very low. It could like drift lower from here, maybe stay around 4%. And some of that's just because like we just don't have as many workers entering the labor force right now, partially due to lower immigration. And so I just think this is one of those headlines that's kind of interesting. And you all, listening to this might be seeing this in the news, but the headline could be just a little misleading because I think you might have like job growth is slowing and maybe it sounds like something's breaking and perhaps that's not what's really happening. And I think other things come to mind, Matt, like from a policy standpoint, a slower labor market, what does that do? It reduces wage pressure. Well, what does that do? That makes inflation reaccelerating out of control much less likely. And so then, like bringing it all back to some of those first slides we talked about with the Fed, that's also something they're watching.
Yeah, this is not my most favorite piece of conversation is talking about labor. So it's not one of the fun ones, but we started this like you just said. We started this talking about what is the role of the Fed and what is the role that they play, and this is one of the big pieces is to control unemployment and as we mentioned a moment ago, inflation. So it certainly does shape our Fed policy.
Yeah.
And I think it sort of reiterates what their belief on interest rates will be due to the fact that we are, in a fairly low unemployment environment. And, I think it just kind of supports where their feelings and how they're going to maintain their fiscal policy moving forward.
Well, yeah, and I think I wanted to bring it up because I mean, it's something that we think about when it comes to planning. We talk about this every week when we're evaluating portfolio construction. So it's not that this is necessarily a red flag, but it's something we're paying attention to. And certainly, you hear about this stuff in the headlines. So not necessarily anything to react to here in this moment or, be a cause for change, but something that we closely watch. And then, I suppose we save the wild card for the end, last but not least, but of course it's the newest development and that's the one that's getting all the headlines right now. It's a
I don't
situation
think we need to talk about this, John. I don't like. Let's just skip this. I don't think anyone wants to talk about the Straits of Hormuz and what's happening in Iran. I don't think anyone jumped on to hear about that. So we could probably
I
skip it.
think
What do you think?
it's just funny you talked about last year with tariffs and how things were happening in real time in the meeting. I have actually since refreshed the news a few times just to see because obviously overnight, we have a 2-week moratorium on between US and Iran. And so that's the markets have responded positively. That's kind of the biggest news at the moment is that Dow Jones is up like 1,100 points as we speak. But obviously, this is a big wild card we got to talk about. So, it's the
Yeah.
impact on oil prices, crude's moved, at one point it was over $100 a barrel. Gas prices $4 or more in a lot of areas. So where should we begin here?
Yeah, and poor Johnny. It sound for you watching this, it might seem like it's just two CFPs just sort of like chatting about like we put a lot of time and effort in preparing for these economic updates and the slides. And poor Johnny is constantly having to change over this last week as we were preparing for this particular presentation.
Well, I love doing.
I feel like every day this slide was either included or not included because and I think again, bringing everything back full circle, it looks so similar to the tariff conversation we had last year. And honestly, the year appears to be shaping like the last year did, right? We had this tremendous amount of economic uncertainty at the beginning of last year. Here we are in a conflict this year, and we're not making light of it by any stretch of the imagination. It's a very serious issue, and there's people's lives at risk. We're looking at it more from the economic standpoint as part of today's conversation. But boy, it's changing moment by moment. And you can also see why the Fed does not include, energy prices as part of their decision making, because how the heck can you do that where every day there is a different tankers are able to either come through or not come through one of the largest, shipping lines and oil lines in the world. So this is one that I just think it's hard to today give you a definitive answer on where we think this is going to go because I don't think anyone knows. But certainly it's something that is part of what we are looking at in the bigger picture. So, I think for us here, which way is our oil prices going? We hope this is the peak and that we will get back to some level of norm because this is not just impacting us when we fill up our cars at the pump, right? This is changing our airfare. This is changing our vacations, the logistics of moving goods all around, right? There's so many far-reaching impacts to our oil prices more than just us putting gas in our car. And this is one that's incredibly important when we're watching extremely closely and it's changing quite literally moment by moment.
Yeah, I think it's a good part to the whole inflation discussion because, again, it's like we look at that slide and go, oh, okay, inflation's like 2.4, 2.5%. And yet we're all filling up our gas going, hold on, how much was that? So, it's, one thing for the data to say X and then what we actually feel is very different. As you said, with travel, flights, all the things we're dealing with, logistics too, like goods cost more to move around. So, that could have an inflation shock. I mean, I think the distinction here, though, is probably more of just like hopefully, a temporary inflation shock as opposed to an actual recession risk. And it's something important to note, like it's kind of interesting, like US is actually a net exporter of energy today. So while higher prices hurt consumers, it also benefits domestic producers. And so there's like this weird overall, mixed impact to the economy. And so I think the expectation or the hope would be like there is a vast range of outcomes, but hopefully it resolves relatively quickly and the impact fades just as fast as it as it came on.
And it doesn't impact everyone uniformly across the board, right? Some of these
Mhm.
areas are hitting the lower to middle income, individuals here in the United States. So it's not proportionate
Right.
across everybody. It's very disproportionate. So it's certainly something we're watching. And as John talked about, as part of our financial plans, especially our retirees living off of a fixed income with inflation built into it and market performance built into that as well. But still taking more out of the portfolio to live the same lifestyle, is something that we are take so seriously, and we're so cautious and protective over your money to make sure that we're never in a situation where we run out. And that's a big
Wow.
piece. And these economic updates, what's the next one for next year? Who knows? There's going to be something. And for us, we're doing our best to stay on top of it and again manage the portfolio using objectivity.
Yeah, yeah. And like you said, I mean, these are some of the biggest things that we're watching at the moment. And I mean, I guess, at the end of the day, like the point that you were just making, like there's always going to be something to worry about and watch for. We don't know what it'll be in a year. We can look back and point to all these, COVID, interest rates, inflation in 2022, geopolitical risk, the markets. Like there will always be a headline. If it bleeds, it leads, right? Like that's like the old saying with the news. And, for us, the way that we look at it is like your financial plan was never built on everything going perfectly. Like it was never how it was intended. It's built to adapt. And, Matt and I often preach in conversations like this or like with client meetings, like this is why we have a live financial plan that can change and it can adapt to the environment that we're in. And it's why we talk about stress testing the portfolio and the financial plan so often for situations that which we can't control, like some of these things. I mean, so at the moment, although this is all stuff that we're looking at, there's no big reactionary changes we're making. It's staying disciplined, staying diversified, and focusing on what we can actually control. But to the point you were just making a moment ago too, Matt, like our ambition and hope when we do these conversations is, if this connects to your personal situation, like that's where we want to lean in and have a further discussion with you. Because at the end of the day, the planning is relative to you is what's most important, not so much the headlines of what's going on. But if this sparks a conversation, if this sparks like, hey, I want to talk to Matt and John, I want to talk to the team about XYZ, that's kind of our ambition for these sessions with you in between the normal review meetings that we have with you. And so something new that Megan on our team helped us create is www.candorpathclients.com. No, it's not one more thing you need to remember and worry about, but it's a easy URL to remember that we decided would be kind of nice for clients to be able to go in there and book an update call, have access to our scheduling, have quick access links for things like your tax portal, your MyPath financial dashboard, our text line, just kind of a one-stop shop of all those things. So something to remember. It exists inside of our website, but if you want to save that one, it's candorpathclients.com. And Matt, I mentioned the tax portal. We're T
Thank
minus.
you.
How many days are we? How are
You
we
know what? We're shooting this on April 8th, and I mean we are flying right along here. We have another portal, which again I think that's number 62 in terms of portals that we have. Part of this is your information is so well guarded that we oftentimes can't even find it. I'm saying that, of course, in joke. Just we know where it all is, but there are a lot of portals out there, all of them safe and secure. And I think, John, you brought up a good point. Why do people get frustrated with their advisor? It's not generally performance. It's I have not heard from my guy or gal. And we really strive to make sure we are accessible. Your questions are important. Your issues are important. And when you don't have either one of those, you have these type of presentations. And I want to just call out one additional team member. We're not up here because we put all this together ourselves. We are surrounded by an incredible team. Raina, who is just our rock star in terms of getting these types of things out there. Of course, we have Renee as part of our concierge team. Megan, who helps keep our head on straight. But there is one additional newer member of our team that has done a really great job. And if you're interested in looking at one of our previous ones, take a look at Brandon Hatcher's previous webinar. It was on retirement planning. I think it's appropriate, maybe not for our retirees, but our pre-retirees, which is a huge segment of our business. The guy just did a knockdown job of explaining some very sophisticated points in a very, very entertaining and simplistic way. And so there are these, we have these on average, what, John, about once a month on various topics.
Yeah.
And
These ones
I would,
once a quarter. These
yeah,
ones are quarterly, but
yeah.
everything else is once a month. Yeah.
We try to
And
find
as
a
you said,
topic.
yeah, the intention, if it's Medicare, if it's IRMA, Social Security, whatever the case may be, taxes, like there's so much happening that we want to create these as good instances to connect with you all, with our clients. And as I said before, just spark a conversation of, hey, we need to talk about that. Like we need to go down that path. And oh, you know what? That wasn't a planning thing that I had, thought to bring up, but now, I want to talk with you all about that. So yeah, well said, Matt. And thank you all for joining us today. It's always fun, even though talking about the markets is sometimes scary, but today the markets are up, so it's not today. Matt, how do you want to bring us home? Anything else you want to end with?
Well, like I said, I just want to thank you all for taking time out of your day to watch this. Of course, share this with any friends, family, anyone who has a concern right now or doesn't quite know what's going on or needs to get pointed in the right direction. And we just love working with you guys and gals, and we're appreciative to our Candor Path family. And we wish you all the best. And we will be in touch with everyone here soon. It's time to get meeting again. Q1 is coming to an end. It's time to jump into a few discussions here. So we're going to go through a lot of these elements, but really more
Just
towards
for
your
Matt's sake,
specific.
make it post April 15th.
I mean, listen, the
I'm here.
IRS doesn't matter. I'll do what I got to do. I'll burn the candle at both ends as long as I need to. But no, I'm here for you guys. John's here for you guys. The rest of the team is here for you. And we just want to thank you for being part of our Candor Path family.
Yep, well said. All right, take care, everybody. Thanks for hanging with us today.
Bye-bye.